In this video, I'm going to do a step-by-step tutorial on how to do the wheel strategy. I'll be breaking down what the wheel strategy is, what the risks are, and how to avoid them, stock selection, as well as strategies for entering a trade. And by the end of the video, you should have a clearer idea on how to run the wheel strategy and what to look out for when using it. So without further ado, let's first talk about what the wheel strategy actually is and how it works. You first start off by selling a cash circle put. Each time you sell a cash circle put, you get to collect a premium. So for example, you sell a cash circle put at $80 strike price and you receive a $2 premium. If the stock stays above $80 by expiration, the put expires worthless and you get to keep the premium. You can then sell another put to keep collecting more premium. But eventually, if you repeat this long enough, the stock will drop below your strike price and you'll be assigned 100 shares at $80 each. When that happens, you switch over to selling covered calls to collect even more premium. So let's say you sell a covered call at $85 strike price and you collect another $2 premium. If the stock stays below that strike, the call expires worthless and you will keep both the premium and the shares. But if the stock rises above $85 by expiration, your shares will be called away at the strike. You still get to keep the premium you collected and you also lock in any capital gain between your purchase price and the strike price. So in this trade example, you not only earn $2 from selling put, you also earn another $2 from selling the call. And because your shares were called away at a higher price, you realize an additional $5 of capital gain per share. In total, there is $9 of profit per share for completing one full rotation of the wheel strategy. Once the shares are called away, this entire cycle resets and you go back to selling cash circle puts again. So that's the basic idea behind the wheel strategy. You collect premium from selling cash circle puts, you eventually get assigned, then you collect premium from selling covered calls. And if the stock eventually rises above your call strike, you walk away with capital gains on top of the option income. Then you simply restart the entire process all over again. Now, at first glance, the wheel strategy can look almost too good to be true. Like, wow, you get to collect premium when you sell puts, then wow, you get to collect premium again when you sell calls, plus you even get to walk away with capital gains. So, what's the catch? Like any strategy, the wheel comes with real risks that traders can sometimes overlook, and this can get them into trouble. For the wheel strategy, it is not any different. So for this, there are two main risks to be aware of. The biggest risk is when you are assigned shares, only for the shares to keep dropping and dropping like grapes.
The reading and drop like grapes, no? Can drop. I can feel it.
This happens because some traders like to sell cash circle puts on very volatile stocks just to collect those juicy premiums. But they often forget that stocks can sometimes go down too. So if that happens, all of a sudden, you're now sitting on 100 shares with an unrealized loss. Sure, you get to collect a few dollars of premium, but if the stock crashes too far, you will end up stuck in a losing position that may not even recover. Beyond Me is a good example of this. If you had sold cash circle puts during one of those pumps because the premiums look attractive, you would have been assigned at a very high price and then watched as the stock fall lower and lower with no clear recovery in sight. In a situation like that, the premium that you collected would be nowhere near enough to offset the unrealized loss. Another example is GameStop. Again, the premiums are huge, but if the stock crashes and you get assigned, you could end up getting trapped with a huge unrealized loss. So that's the first risk. The second risk is not having enough capital to run the wheel. When you sell a cash circle put, you should have the full amount of cash ready to buy 100 shares. Some traders try to get around this by selling puts on margin. That is not a cash circle put, that is a naked put. And being naked is not always a good thing, especially in this situation. Because if you do get assigned, you now have to buy 100 shares using borrowed money, which means you have to start paying margin interest immediately. On Moomoo SG, the margin interest on USD is around 4.8%, but other brokers can charge even higher, sometimes closer to 12%. You are paying this interest every single day you hold the shares, and that is not even the worst part. The worst part is when the stock keeps dropping, because if it drops slow enough, you'll be slapped with a margin call, and the broker will liquidate your holdings at a loss. So these are the two major risks when trading the wheel strategy. Now, let's talk about how to avoid these risks. First up, the most straightforward and obvious way to avoid the insufficient capital risk is to make sure you actually have enough cash to buy 100 shares. So, for example, if you only have $1,000 cash, you should not be selling puts on a $50 stock Because if you get assigned, you will need $50 times 100 or $5,000 to buy the 100 shares. So you either have to top up more money so that you can buy the shares using full cash, or you choose a cheaper stock that you actually have enough capital to support the assignment in the first place. Also, if you're using a lower cost broker like Moomoo SG, it's not as though your capital is just sitting there doing nothing while you wait for an assignment. In the Moomoo app, if you head over to Wealth, Cash Plus, and turn on Smart Save, your unused cash will automatically be invested into Cash Plus. This allows you to earn a yield on your idle funds while still keeping the cash accessible. The money parked in Cash Plus is used as collateral, aka margin when you sell cash secured puts. And if you are ever assigned, Moomoo SG will automatically redeem the funds to purchase your shares, and margin rate may apply. On top of that, the option premium you collect is also automatically swept into Cash Plus, so even your premiums continue earning you while you wait for the next step of the wheel. This way, your capital is still working in the background instead of sitting idle between trades. Next, let's talk about how to avoid ending up stuck in the lousy stock, and that's by choosing a not so lousy stock in the first place. That is Captain Obvious, but jokes aside, when you do the wheel strategy, you want to choose stocks that are fundamentally good. By that, I mean stocks that have strong financials, so that even if they crash, you know they have a reasonable chance of recovering and continuing to go up over the long term. So how do you know that these companies are fundamentally strong? One quick and simple way is by looking at their revenue and net income. Here is Microsoft. You can see that their revenue has been steadily going up over the years. The same goes for their net income, which is going up over time. If I switch to Google, you will see a similar pattern. The company has consistently grown its revenue and net income has continued to trend up as well. And this is important because stocks that have this kind of financials have a higher likelihood of recovering from crashes. For example, if we look at Microsoft, we can see that over the past decade, Microsoft has gone through multiple crashes, sometimes even more than 30% during market sell-offs. But because the company has good fundamentals, the stock not only survived the crash, it also recovered each time and went on to reach new highs. And if we check Google, we can see the same thing. The stock has had several periods where it fell sharply, but because Google has strong fundamentals and continues to generate solid revenues and profits that grow over time, the stock has always managed to recover and go higher. However, if I switch to a stock that's fundamentally not so good, for example, GameStop, you can see that their revenue hasn't really been going up. Same for their net income. Sometimes it's positive, sometimes it's negative, and there's no clear trend at all. As a result, the stock is having trouble going up over the long term, and that makes it very risky to run the wheel on, because you never know when you will get stuck holding the 100 shares that will never recover. Now, after you have found a good stock, you can actually go one step deeper to improve your odds of success even further, and that is by checking the stock's fair value. Sometimes a company can be fundamentally strong, but the stock price may still be too expensive. If you sell puts when the stock is overpriced, there's a higher chance that it will pull back and you end up getting stuck at a high price. And you might have to wait years before the stock comes back up. That's why it also helps to have at least a rough idea of what the stock is actually worth. Now, there are several sources that let you easily check the fair value of a stock. For example, on the Moomoo app, if you switch over to the company tab, you'll find the fair value estimate from Morningstar Research. In this example, Morningstar believes that Meta is currently trading at about 25% below its fair value. Another one of my favorite platforms is Guru Focus. If you head over to the DCF tab and you key in what you think the stock's future growth rates might be, you will get another fair value estimate. Since Meta grew its earnings per share at around 20% over the past 5 years, if I assume that it can continue growing at 20% for the next 10 years, the model shows that the stock is about 4% undervalued. If different platforms give different fair values, I usually take the more conservative estimate. You don't have to pinpoint the asset fair value. This is just to have a rough idea where the stock is currently trading at, so that you can avoid selling puts on an overpriced stock. Okay, let's try another example, Palantir. Palantir is a fundamentally good company, and its revenue and net income have been steadily going up. But Morningstar shows that the stock is currently about 25% above its fair value. Likewise, if I go to Guru Focus and assume it can continue growing its earnings per share by an average of 30% over the next 10 years, the DCF calculations shows that the stock is very overvalued. that does not mean Palantir is a bad company. It simply means that at today's price, the stock may be trading above its valuation, and that can increase the likelihood of a pullback. So if you sell puts when the stock is overvalued, there's a higher chance of getting assigned at a high price. And if the stock drops, you'll be forced to wait a while for the stock to recover. Now, with that being said, if you don't want to go through all this trouble of checking the stock's fundamentals and fair value, a much simpler way is to run the view strategy on broad-based index ETFs instead. For example, you can look at ETFs such as the S&P 500 ETF SPY, the Nasdaq 100 ETF QQQ, the Tech Sector ETF XLK, the Financial Sector ETF SLF, and the consumer-focused ETFs like IYC. The good thing about broad-based index ETFs is that they tend to rise over the long term because they represent the entire economy or the entire sector. And as the economy grows and companies innovate, these indexes will naturally move higher over time. So even if they go through major sell-offs or bear markets, history shows that they can eventually recover and reach new highs. This makes them a safer choice for the view strategy because if the price drops and you get assigned, the probability of a rebound is generally much higher as compared to an individual company. Another benefit is that broad-based ETFs are not dependent on the performance of any news or any single stocks. For example, a company's stock can plunge when it announces bad earnings, the CEO says the wrong thing. Heck, the stock can even crash when another company makes some announcement. Individual stocks can react sharply to all sorts of headlines. On the other hand, broad ETFs are far more stable because they are made up of many companies. One company dropping 20% will hardly move the entire ETF, so the chance of a sudden dramatic collapse is much lower. This makes broad-based index ETFs a much safer choice for running the view strategy, especially if you prefer a more steady and predictable approach. Next, once you have identified the stock or ETF that you want to view, you generally want to sell the cash circle put when there's a high probability that the stock will go up afterwards. But how do you know when that probability is higher? One way is by looking at the RSI indicator. RSI is an indicator which helps you gauge whether a stock is overbought or oversold. When RSI drops to around 20, it usually means that the stock is oversold and may be due for a rebound. For example, you can see that whenever RSI reaches the 20 level, the stock tends to bounce back up. So if you have sold a cash circle put at those points, you would have entered near the lows and benefited as the stock recovered. On the other hand, when RSI is around 80, it indicates that the stock is overbought. Selling a cash circle put at these levels would be riskier because the stock is more likely to pull back. If that happens, you could get assigned at a higher price and end up holding shares that take time to recover. Besides RSI, you may also want to pay attention to support levels. Selling your cash circle put near a support line increases the likelihood that the stock will rebound when it touches that level. For example, the S&P 500 ETF had a strong support zone around the $652 level. Back in October, the price bounced off this level, making it a clear support area. So if you have sold a cash circle put around that zone in November, you will have entered very close to the bottom. What made the setup even stronger was that the RSI was also near 20 at that time, which further increased the chances of a rebound. Another example is Nvidia around the $92 level. In August 2024, the stock bounced strongly off the support. So during the market drop in April 2025, that same level acted as a support once again. With RSI near 20, the moment Trump reversed his tariff announcement, the stock rebounded sharply off the zone. If you had sold a cash circle put near that level, you will have captured the bottom and gained from both the premium and the upside move. But if you are unsure where the support and resistance levels are, you can check out Moomoo's Market Position Overview tool, which highlights potential supports and resistance levels across different time frames. And if you open the Technical Sentiment tool, you can see interpretations of various indicators at a glance, such as which signals are currently pointing to bullish or bearish. So in short, using RSI together with support levels will give you a much better chance of selling your cash circle put at a favorable point instead of guessing or entering randomly. Now, once you have found a suitable entry point, you are ready to sell your cash circle put. At this stage, how you want to sell a put depends on one simple question. Are you okay with getting assigned, or do you prefer not to be assigned? If you prefer not to get assigned, then the puts that you sell should be around 45 days to expiration. and around 30 delta. 45 days to expiration because Tasty Trade backtested this and found that at below 45 days to expiration, the expected move of the stock is generally lower than the realized move of the stock. But when you go 45 DTE and above, the expected move was consistently bigger than the realized move. As for Y30 delta, Tasty Trade did a backtest on SPY and found that a delta of between 10 to 30 will give you the highest return on capital per day. So with 45 days to expiration and around 30 delta, this will give you a higher probability that the option will expire worthless and you simply get to keep the premium. Though the trade-off is that your returns will generally be lower. That's because when the DTE is further and delta is lower, you receive a lower premium. And because the chance of assignment is also lower, you are less likely to capture any capital gains from the stock rebounding. So this method is good if you want to collect an income while avoiding getting assigned, but the returns are usually modest. However, if you're okay with getting assigned, you can go with a shorter DTE, say around 5 to 15 days, and a much higher delta, say around 0.3 or 0.4 or higher. This gives you a higher premium and a higher chance of assignment. And if the stock rebounds after you enter, you not only collect the premium from the put, but you may also get capital gains once you switch over to selling covered calls. So while the risk of assignment is higher, the potential return is also significantly higher. Neither approach is right or wrong. It simply depends on your objective. If you want relatively lower risk and more stable income, then further DTEs and lower deltas would be better. But if you are comfortable owning the stock and want bigger profits through both premiums and capital gains, then shorter DTEs and higher deltas method will usually give you higher returns. Here's a pro tip. In general, the best time to sell options is when volatility is higher. One simple way to check this is by looking at implied volatility. On the Moomoo app, if you go to Options, then Analysis, and scroll down, you will find a section called Volatility Analysis. When IV is high, it means that the market expects larger price movements in the future. Because of that uncertainty, option prices tend to be higher, which allows you to collect more premiums when selling puts or calls. On the other hand, when IV is low, option premiums are usually smaller, and you are taking on similar risk for less reward. Two useful indicators here are IV rank and IV percentile. This will tell you how high the current implied volatility is as compared to its historical levels. IV ranks compares today's volatility to the highest and lowest volatility over a certain period, while IV percentile tells you how often volatility has been lower than the current level. Ideally, you want to sell options when both IV rank and IV percentile are relatively high, because that means you are being paid more compared to the stock's usual behavior. Another data point that I find useful is the volatility smile. This shows how implied volatility changes across different strike prices and will give some insights into where the market is pricing risk. For example, if the volatility smile is skewed towards the downside, it suggests that traders are more concerned about downside moves. In that situation, put options tend to carry higher premiums, which can make selling cash secured puts more attractive. So that's for selling cash secured put. For selling covered calls, the idea is pretty much the same, but the opposite. You want to wait till the RSI reaches 80 when it's overbought so that the chances of a pullback is higher. You also want to choose a strike price that's above the resistance level, and ideally only sell when IV is high. And if you don't want to get assigned, you can go for 45 DTEs and lower delta. But if you don't mind getting assigned, you can go for shorter DTEs and higher delta. Alright, here's a quick demo on how to sell an option. First up, open up the stock or ETF that you are interested in. Then head over to the Options tab, where you will see the option chain. The next step is to choose the expiry date. In this example, I will go with 16 days to expiry because the IV on this expiry is around 20%, which is significantly higher than other dates. And higher IV generally means better premiums. On the left side of the screen are call options, and on the right side are put options. Since I want to sell a cash secured put, I will focus on the right side. The stock is currently trading at around $610, so I'll choose the $600 strike, which should give me a stronger support level. Next, make sure you change the order from buy to sell. This is very important now, because you want to sell the option to collect premium, not buy it. If I drag the panel up, I can now see the profit and loss analysis for this trade. For this option, I'll be collecting around $539 in premium, so my maximum profit is $539. If the ETF were to drop all the way to zero, my maximum loss would be the strike price multiplied by 100, which is $60,000 minus the premium collected. This gives a maximum loss of $59,461. The break-even price for this trade is $594.61. Based on the current pricing, the probability of profit is around 74%. Once you are comfortable with the trade, you can tap on trade and enter your order details. For the price, if you want a better chance of getting filled while still aiming for a fair price, you can tap on the target icon and select the mid price. This will automatically set your order between the bid and ask, which is usually a good balance between speed and pricing. After that, you can review everything one last time and proceed to sell the option. Also, just a quick note, if you are using Moomoo SG, they are currently offering 0 commission for US options on up to 100 contracts per month. For new users, there's also up to $120 worth of option-related benefits, along with up to 1,315 SGD in new user rewards if you sign up today. So, if you're actively trading options, this can help to keep your costs much lower over time. Next, to make your trade even safer, you should always try to diversify your trade. There are multiple ways to do that. The first method is to split your entry points. So let's say you have enough capital to sell 5 cash secured puts. Instead of selling all 5 at one single strike price, for example, all at $180, you can stagger your entry levels at a few percent apart, such as at $180, $175, $170, $165, and $160. Or you can stagger across various support levels. For this example, it is at $180, $175, $167, $158, and so on. This way, even if the stock continues to fall, you will not be fully exposed at the highest price. You will also have opportunities to sell puts at lower levels, which can help to reduce your average cost if you eventually get a sign. The downside is that if the stock bounces immediately after your first few entries, only a few of your positions would be filled instead of all of them. So you will make less profits as compared to entering everything at the highest strike. But in return, you get better safety. By spreading out your entries, you avoid getting stuck with your entire position at the highest possible price, and it gives the wheel a much better chance of working, even during deeper pullbacks. Now, besides splitting your strike levels, another method I find helpful is to stagger the days you sell your options. That's because volatility moves up and down all the time, and the premium that you can receive can vary from day to day. For example, if earnings are coming up or the market suddenly drops, implied volatility often jumps. So by staggering your entries across several days, you increase the chance of catching at least some of those better premium opportunities rather than locking everything in on a low volatility day. And lastly, you can diversify by using different stocks. Instead of putting all your real positions into a single ticker, you can spread them across several fundamentally strong names. For example, you might run one wheel on Apple, another on Google, and maybe another on Nvidia. Even though they are all good companies, they each move differently. This way, if one stock pulls back due to a company-specific news, the others may not be affected in the same way, and your entire wheel portfolio will not be dragged down all at once. From there, you can also diversify even further by choosing stocks from different sectors. Right now, tech stocks tend to have higher impact volatility, which means you get higher premiums by doing the wheel strategy on those stocks. But during a bear market, tech stocks often fall the hardest. By adding stocks from other sectors such as financials, consumer staples, utilities, or healthcare, you reduce the risk of being overly exposed to a single part of the market. Not only that, many sectors also tend to hold up better during downturns, which gives you steadier foundation for running the wheel strategy over the long term. So that was a quick guide on how to do the wheel strategy. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.